In this short video, we will discuss pair trading. The topics we will touch on are defining pair trading, discussing the goals of a pair trade, defining the risks of pair trades, and discussing different types of pair trades that are available. Pair trading is a market-neutral style of portfolio management in which the goal is the performance of one asset relative to another asset. There are a number of assets that can be used to create pair trades. These range from stocks to ETFs, futures, along with over-the-counter products. A pair trading strategy is understood to be market neutral in that it takes on opposing directional risks in an effort to create a basis trade. For example, a classic pair trade is one in which an investor purchases a specific notional value of one stock and simultaneously shorts the same notional value of a highly correlated stock. A perfect example of this would be to purchase Coke and to sell short Pepsi. Pair traders benefit by finding pairs of stocks or assets that are co-integrated and potentially have similar business models. Another example would be Morgan Stanley and Goldman Sachs, which both participate in the investment banking business. The concept of a market-neutral strategy is a strategy that attempts to avoid the beta of the market and benefit from relative value. For numerous types of reasons, similar assets will diverge in price and will eventually snap back to a long-term historical mean. The length of time of the divergence and then the following convergence can be estimated, which allows specific types of strategies to be created. The returns that a pair trading investor is looking for are generally smoother than directional risk, as the change in the basis is generally slow and steady. Obviously, there are circumstances where a scenario unfolds where a spread risk becomes volatile, and the investor should understand the specifics associated with pair trading strategies. This trading strategy allows investors to capture gains without a large move in the direction of either stock. The concept of market neutral has never been more important, as it allows a trader to capture profits in sideways markets while limiting the risk associated with the overall beta of the market. Investors who attempt to trade pairs are looking for pairs of stocks or other assets and to take advantage of the times when the stocks diverge and their correlation breaks down. Many times a breakdown in correlation will follow earnings releases or a specific corporate announcement, while other times they will diverge for no apparent reason. Tracking the price action associated with pairs of stocks will allow an investor to take advantage of rich and cheap relative value situations. When a stock splits or does a reverse split, the ratio between the stocks will change, but this does not represent an opportunity to initiate a pair trade. Pair traders look at relative value of an asset pair as either a ratio or a spread of prices of the assets. For example, when looking at a stock pair such as Exxon versus Chevron, a portfolio manager could look at the change in the ratio or the change in the spread of the prices. The change in the ratio represents a percent change in the stock and is the preferred method for analyzing changes in values of a spread or pair. Although investors do not face directional risk, spread risk needs to be monitored and stops need to be implemented just as in other market instruments. Exiting a pair transaction can be based on a percent profit or the loss calculation or a relative value calculation. A ratio calculation would require an investor to chart a ratio similar to charting an individual stock. Finding a point to place a stop is imperative to successful pair trading as well as any trading. Highly correlated instruments tend to converge and diverge with a range that can be tracked using mean reverting statistical instruments such as the standard deviation. The process will allow a trader to either backtest or visually generate historical ranges for a pair trade. In this example, you can see that the ratio of a highly correlated pair, Coke and Pepsi, move within a range, reverting to a mean in most instances. Managing pair trades are similar to managing directional risk, to the extent that a portfolio manager needs to look at each transaction and create a risk-reward profile. The major difference in managing these types of risk is that an investment manager cannot rely on observing the outright delta of the portfolio or value at risk to realize the extent of the risk of a portfolio. Most brokers offer the ability to short a stock within a margin account. This means that an investor will be buying the stock and then selling it in the hopes that it will underperform relative to a stock that the trader is long. Additionally, investors can create the same type of position by purchasing pair options. A call option on a pair creates a positive return if a stock pair moves in favor of the asset that an investor will outperform over a specific period. A put option is the reverse on a pair and creates a positive return if the stock pair moves in favor of a short asset over a specific period. Pair options have generally been available only to institutions, but recently have been offered to retail public by online brokers. Currently, pair options are available in binary form as above or below options. These binary options are offered in intraday and multi-month long periods of time. Pair options or spread options, in which a trader needs to not only manage the basis risk, but also additionally correlation risk associated with pair options. When options are priced as a pair or a spread, not only do you use a Black-Scholes model, it's a bivariate Black-Scholes model that incorporates a correlation coefficient. Pair trading is one of the best market-neutral strategies available, but there are risks that should be accounted for prior to entering this type of trading vehicle.